Designing a trading strategy is pretty tough. And that's really only if we include technical factors. And if we start adding in fundamentals and seasonal cycles, it gets that much harder. And there are a whole lot of variables that we should really keep in mind when we're designing our strategy. What indicators we're going to use, what price points we're going to use, time horizons, including our outlooks, our stops, and our targets. And the reason that Netpicks has been around for so long and produced many who trade for a living is because this is hard work. And our experience in trading and system design helps lessen that load and really gets you on the road to being profitable quicker than going it alone. The sheer amount of combinations that you can put together to form a viable trading strategy is pretty overwhelming. And just when you think you've found a pretty good strategy, that work just begins with your back testing. And that includes finding out if it's even better than random. Is it better than a random selection of variables with a random data set? Why would you want to test your strategy against random data? If I string together a few hundred strategies using a selection of variables that I choose randomly, as I'm going to show you in a second, a true edge will outperform another set of random variables applied to random data. Now, statistically, since we're using a broad search, there should be outperformance with a good strategy just by chance. So as an example, if our basket that we're drawing from has 10 variables, and we pick 3 randomly, and we test them against real data, and then we take another selection of 3, and we apply that to random data. Now, with the power of computers, it's a whole lot less burdensome to be able to test literally millions of combinations of strategies and variables to actually find a strategy that has promise. Now, there is that issue of curve fitting your data to make that tested data look a whole lot more appealing. However, that makes the edge not really an edge if you've curve fitted. So avoiding curve fitting is a must. And there's another issue of random luck. So when you take a few variables and you apply them to a data set, that result may look extremely good and prompt you to believe that you're trading a strategy that's worth using. Well, the question is, if the variables that you pick are random and you apply it to real data, how do you know that it's not simply chance that your trading strategy looks good? Well, you compare random variables to random data. Now, this is an equity curve of a tested long-only trading strategy, and it's for the S&P. And we're using a date range of January 1st, 2004 to May 21st, 2014. And some other things you want to keep in mind that the win rate is 75%. The profit factor was 3.36%. And the compound annual growth rate was 10.10. Now, the strategy uses the following variables in terms of each actual trade. Now, this is not a strategy recommendation, but feel free to test it. So the open of 6 bars ago is less than or equal to the close of 9 bars ago. The high of 6 bars ago is greater than the low of 9 bars ago. We're using an RSI setting of 2. Today's close is greater than or equal to 5, and still using the RSI setting of 2, today's close is less than or equal to 15. So right there, we're looking at what? We're looking at something that has been oversold. Also consider that our stop loss is going to be 2 times a 20-period ATR. We're going to hold this trade for a maximum time of 10 days. And our entry and our exit is going to be on the next open after the trading signal is generated. Now, for giving the last 6 months of 2008, this equity curve looks pretty good. And it would be very easy as a trader to discount the issue in 2008 and begin to commit real money to the strategy. Well, to consider our strategy having a true edge, we need to see it compared to something to see that it outperforms in the comparison. Now, given that we're using a huge database of variables and we're taking a random set of variables, statistically, we should see some outperformance. And a way to do that is to compare your strategy to a random baseline and expect to see your strategy perform stronger than random. We need to see that our possible edge does better than something that is found by random chance. The solid blue line here is the original equity curve from the first chart, and the red lines are random signals and random data. our strategy that originally looked really good did not outperform random signals and data. What we would want to see is that blue line well above the red lines. Now keep in mind for this example, I used random variables plus real data and random data. Now a trader that's using a strategy that was not chosen randomly can test that strategy by taking the strategy that we just talked about and test it against their own variables. So if the strategy is not better than random, what trading edge are you taking advantage of? None. And that's similar to people trading support and resistance levels. And I talked about the danger of support and resistance levels before. And you put the lines on a chart, and the question you should ask with any trading approach, is it better than random? Now, this is only one test that you'd want to consider when designing your own strategy, but I think it's one of the most important ones. You start with a hypothesis. You assemble a range of variables to consider to serve that hypothesis, and you test against various data sets. You want to look for a strategy that outperforms random samples. And then when you get that, you may have found a trading edge that will serve you for a whole lot of years to come.